Amazon, and do I even need to introduce what Amazon does? It's just Amazon. Amazon reported earnings after the market closed today, and the markets had a muted reaction, which might make it seem like it was a boring report. But as I'm going to show you over the next 10 minutes, I feel pretty confident this is a significantly undervalued stock right now. So let's spend the next 10 minutes figuring that out. My name is Brian Stoffel. As of the time of this recording, I do own shares of Amazon. In fact, makes up about 9% of my real life holdings. I want to give a shout out to finchat.io for sponsoring today's video. More from them in just a minute. So this was Amazon's first quarter of 2024. It'll be about a $1.9 trillion company in that ballpark when the market opens tomorrow. So revenue on the top line was up 13% to $143 billion. That was just ahead of Wall Street's estimates. It was also pretty significantly ahead of the midpoint of management's own guidance. Earnings per share beat estimates by quite a bit and a significant jump from last year, but it's this last one in the lower right-hand corner that really stands out. Management said they thought that operating profit could be between 8 and 12 billion, and it came in at $15 billion. We're going to talk more about why operating profit and operating cash flow is so important. But before we get to that, let's just look at the margins. Across the board, it was good news. Gross margins expanded. Operating margins expanded meaningfully, just about tripling. Net margins also almost tripled to 7.3%. Those are very good margins for a business like Amazon runs. Free cash flow went from a loss of $9 billion in the first quarter of last year to a gain of $4 billion. So in other words, free cash flow improved by about $13.5 billion over the trailing 12 months just because of this quarter. Net income more than tripled. And the balance sheet has been all over the place in the last 5 years. Today, it stands in pretty good shape with a net cash position of just under $30 billion. So let's look at this from the income statement's point of view. We had sales up 13%, which is pretty good, but what you're going to see here and what investors should be excited about is that Amazon is squeezing the profits out. It is showing just how profitable this business can be, and it is impressive. So 13% revenue growth, but the cost of those sales was up just 7%. That's why gross margins expanded. But look at this. The cost, the operating expenses to run the business. Fulfillment was the only one that was up meaningfully. Everything else, tech and infrastructure, flat. Sales and marketing, down. G&A, down. Overall, operating expenses was only up 1%. So what happens when you have 13% revenue growth and just 1% growth in operating expenses? Well, you get this. Operating income was up 121%, and that is way more meaningful than net income. Why do I say that? Because right here, the other income and expenses, that's investments that Amazon's made, particularly in Rivian, which makes everything else below it absolutely meaningful. So again, that is why this 121% jump, that is what should really stick out to investors who are focused on profits. It is worth pointing out that shares outstanding was up 3%. That's something to keep their eye on. But let's dig into what was actually going on under the hood at the company. And for that, we're going to go to finchat.io. If you want to get a subscription to finchat.io, you can get 15% off by using the link in the show notes below. And I think you're going to see very clearly why this is a tool I use all the time. So I went to finchat.io and I put in Amazon's ticker symbol, and I went down here to this tab that says segments and KPIs. And here's why I am so impressed by this, because the company just reported a few hours ago, and already all of this information is ready for me and I can look at it. So here's what I mean. So first, this is online store. So this is if you order something, Amazon branded, sales were $54 billion. And as you can see, that's up 7% from the same time last year. Not the days of heady growth as in the past, but still not bad at all. What happens if we look at physical stores? And this basically just means Whole Foods more than anything else. Some other things, but sales were up 6.3%. That's not something a whole lot of people focus on. Here's something I really focus on, which is third-party fulfillment. Why? Because this is like Amazon flexing its muscles and showing you that this fulfillment network that it has throughout the globe, North America in particular, but throughout the globe, it's selling third-party goods and it's collecting high-margin revenue to deliver those goods. And sales there was up 16%. It remains strong. It has not tailed off as much as people thought after kind of flattening out after the pandemic. This is important because this is a very wide moat business. And I think that is very good news. And what about advertising, which is incredibly high margin revenue? It's not a business I'm crazy about because I think it goes against Amazon's mission statement of being Earth's most customer-centric company. That being said, this high margin revenue came in at $11.8 billion and grew 24%. So that is great news. We could look at subscription, but what I really want to get to here is AWS revenue because that's a big deal. Here's why that's such a big deal. If you follow Amazon, you know that AWS, you look at these sales, 25 billion is a lot, but it's not as much as the others that I showed you, but it is incredibly profitable. And this blue line right here, doing what you see right here, this is the most important thing that I think any investor can see. And that's because growth is re-accelerating. We saw it slowing down here. ChatGPT introduced somewhere around here, continues to slow. It inches up ever so slightly right here. And then in the holiday period, again, ever so slightly. But now it is meaningfully accelerating. And that is so important because it means that Amazon is seeing what we've already heard from Google, from Azure, from other cloud players. And that is that AI is a reaccelerator of cloud growth. And this is a reacceleration of growth in Amazon's most profitable business. How profitable? Again, let's look at finchat.io. This shows operating income that Amazon has gotten from its three segments that it breaks out. It's North America. That means if you buy something on Amazon.com, in North America, international, and then AWS. And as you can see, this section right here throughout, that is the moneymaker. Now, the company did do pretty well. They got about $5 billion in operating profit from North America, and they did turn a profit internationally. The first time they've done that since the middle of 2021. But overall, you've got the most profitable segment of the company seeing its revenue growth reaccelerate. Now, management did say that they're going to be investing a whole lot in that, but you can see why. So the profitability might take a little bit of a hit. Free cash flow might take a little bit of a hit because the company is going to be investing a whole bunch, but you can see why. It is a wise move to do that. So it's not surprising to see that happen. It is also worth pointing out that the last thing I'm going to show here is that this is AWS revenue in blue. This is AWS operating profit in orange. And if you do a little bit of math, $9.4 billion in operating profit on $25 billion in sales means that the AWS had operating margins of 37%. Already a year ago, right here, it came in at 24%. And that was pretty impressive. But it increased by 50% to 37% operating margins. That is an enormously good read for investors who are thinking, who own shares in the company. So let's talk about guidance moving forward. Management guidance for 9% growth on the top line. This number is actually incorrect. I apologize. What Wall Street was hoping for was about $150 billion. It should be $150 billion. So that came in below expectations, but I'm guessing the reason that shares didn't plunge on that is that the midpoint of management's guidance is for $12 billion in operating profit. And last year, it was just $7.6 billion. If they blow their previous guidance out of the water as they did this quarter, I wouldn't be surprised to see operating income double again in the next quarter. For the full year, Wall Street is expecting $641 billion, 11% growth overall. So what should investors watch moving forward? Well, first are those operating margins, AWS operating margins, but also the North America segment. Look, management said they're cutting costs in their e-commerce business, and they are still able to speed up the delivery of their products, which is an enormous moat because nobody can do that at a lower internal cost than Amazon can. So those operating margins are important. AWS, ads, and that third-party seller services. That's where the network of fulfillment centers comes in. That has an enormous moat around it. Third, international sales, which we saw had operating positive income. And fourth, free cash flow. Overall, I have no doubt that the moat is widening around this business and the thesis is very much on track. So when I run it through my checklist, this gets a 13. It is definitely in the anti-fragile category. But I started this out talking about how I think that the stock is actually priced below what I think it's worth. And I want to talk about that now. If we focus on where the company is in its business growth cycle, it's in stage 4 because it is squeezing out that profitability. So we can look at a whole bunch of different metrics to see that. But I want to point out the one metric that really stands out to me is price to operating cash flow. This is a pretty good predictor, range bound valuation for Amazon over time. Now, the difference here is we pull out capital expenditures because Amazon goes in feast and famine periods where it is spending a ton building out its infrastructure, its fulfillment centers, and now its cloud capacity, especially with AWS and its data centers. It's going to be doing that. But operating cash flow just kind of levels all that out by taking the capex out. And the bottom line is this: you can see that it is pretty range bound between about 20 times operating cash flow to as much as 40 times operating cash flow. I think a safe bet is to say that usually over time it's at about 25 times operating cash flow, somewhere in that range. And yet, after today, before today, it traded for 22 times operating cash flow, but the company now has $99 billion in operating cash flow over the past year. That means that it is now trading for about 18 times operating cash flow. Let me just show you where that is right here. That's almost at an all-time low. I'll say it again. That's almost at an all-time low for the company. It's right there. If it were to trade for 25 times operating cash flow, that's at least 30% upside from this price today. So I don't think that Amazon's ever going to be a 10 bagger moving forward, but I also think it has a pretty predictable business. It has an enormous moat around itself, and now it's focused on being profitable. So it is going to squeeze out a lot of profits. It is going to be spending a lot of capex on AWS, but its e-commerce divisions are really focusing on being profitable. So I remain very bullish on this, and I would not be surprised. I feel comfortable saying that I think this is at least 30% undervalued based on this that's right here. But let me know what you think in the comments section below. Is this right? Is it not? Don't forget to subscribe. And of course, we will check back in on this one in 90 days. Until then, Brian, out.